All right, welcome everyone to week 10 of the course. It's week 11 of semester, but because last week's lecture was postponed, this is week 10 of the actual module. Before I start, there are just a couple of announcements. Next Thursday, 6th of November, you will have the second midterm, okay? So that starts at 7 p.m. and it will be in Auditorium 2 in Utown. So I sent out some instructions on how to get there, the location, etc. Be there for 7 p.m. sharp. The format of the test will be very similar to the first midterm. Okay, it's a short paper, about 15 or so questions, all answers submitted on the question sheet, pretty much multiple choice. You will need a scientific calculator, okay? Because there will be some calculations involved and you'll have to write down some numerical numbers. But no other devices, okay? So you can't use ChatGPT or your laptops. It's open book, so you can bring in cheat sheets or any printed material, right? Exactly the same as last time. In terms of what it will cover everything from week 1 to week 10. Okay, so the stuff we cover today will come up lightly. Okay, and in terms of the replacement lecture, that will happen Saturday, the 8th of November, 2 p.m. It'll be in here. Okay, so we'll catch up by next Saturday, and we will have that replacement lecture in here in the afternoon. Are there any questions on any of that admin stuff? No? Okay. Right, so where are we? Basically, we're done with standard Black-Scholes. Okay? You've seen pretty much everything there is to know about just the standard Black-Scholes. We've looked at the mathematical modeling, all the assumptions involved in constructing the framework, the model. You've seen the PDE and all the economics involved in deriving it, right? By the way, this is all stuff that you should be very comfortable with. It could come up in an exam, for example, in a question. We've solved the PDE numerically using PDE grids, using Monte Carlo. We've converted it into an expectation, which you then solved in closed form. Okay, you've seen that as well. And you've also seen the delta hedging framework around just a standard vanilla call or put option. Okay? There really isn't anything else. That's it. As far as standard Black-Scholes is concerned, that's everything. What we will pivot to now are kind of the more advanced topics. So we'll start talking today about, well, what are the shortcomings of Black-Scholes? Okay? As I said right at the beginning, the Black-Scholes framework is just a model. Okay, and a model is nothing more than someone's representation of the real world. Okay, it's just a representation. So the real world is going to do whatever the real world wants to do. Just because you have a model that gives you a price, it's not going to go with that price. Or it may not. All right? Or it may partially go with that price and come up with a better price. The assumption we make in this course, and that most quants will make in banks, is that the market is efficient. Okay, so the market trades without any arbitrage. The prices of products on the market are governed by supply and demand. And whatever those forces determine, the price will settle on some equilibrium value, and that's the value. Okay, so a good model will replicate that value. If it doesn't, it's not a good model, or it needs some fine-tuning. So now we're going to start talking about the fine-tuning that we need to put in place around Black-Scholes to get better prices. Okay, and we started on this last week already. The key topic, not last week, 2 weeks ago, the key topic really that we left off with was this idea of implied volatility. Okay, which is, what is the volatility that you need to put into the Black-Scholes pricer to get out some target price. Okay. And that's a numerical problem. You have to solve it numerically using either bisection or Newton-Raphson. Again, algorithms you need to be very comfortable with. Now, some of you might be wondering, and a couple of students have already asked me this, so I understand the confusion. It's like it's a bit of a circular argument. You know, we spent, what is it now, 6 weeks talking about Black-Scholes. We came up with a price for a call and a put option, and now I'm telling you, we don't believe those prices. We just read them from the market, right? What was the point of all this? And it's a valid question. It's a bit chicken and egg. And the answer is that, well, first of all, we're learning a framework, right? The purpose of this wasn't just to come up with a pricing formula and use it without any understanding. We learned a framework, the no arbitrage, hedging, replicating. It's all a philosophy, right? It's an economic philosophy that we learned. And secondly, just because the market prices are available, it doesn't make the model useless. Okay? Because we can still use the model to price more complicated derivatives. And that's really where we're going. That's really where most quant work is. Right? No quants are really, they don't spend their time trying to price calls and puts. They do spend their time trying to price knock-in, knock-out barrier calls and puts, or American calls, or some other funky path-dependent product. Okay? There we do need a model. We can't extract prices from the market. But we need the model, we need to build some confidence around our model, which means that if we use the model to price something that we can observe in the market, it better get it right. Right? If you can't reprice what's already in the market, then you don't have much confidence in this new model that you come up with. So that's really where we're going. And to understand some of these shortcomings, we introduced this idea of implied volatility, which is really the entire topic of today's session. Okay, so we'll have a recap. I'll recap what implied volatility is. And then we're going to turn our attention to understanding what's happening in the market. Okay, so we're going to assume that there are these prices for vanilla calls and vanilla puts in the market. And the question, at least for the first part of today's lecture, is, well, what can we learn from that? Okay, what does that tell us? And we'll look at implied volatility in sort of two dimensions. One in dimensions of time and one in dimensions of skew, which is underlying, right? It's strike, but basically in dimensions of stock or underlying asset. We will extract, basically we'll talk a lot about, what we will talk a lot about today is that the log normal model isn't quite good enough, right? It was a good start, it works, it gives you prices that are maybe semi-sensible. It doesn't give you exactly what's in the market, which means that the market doesn't believe that the underlying asset is log normal. Okay, so if it's not log normal, then what is it? And that's kind of the fourth point here. We extract a market implied probability density function. And that sets us up to introduce this thing called local volatility modeling, okay, which is how do we correct Black-Scholes to reprice these instruments that we see in the market. Right? We're not going to spend too much time on this. It's important that you're aware it exists, but I don't see it used very often. It's a little bit unstable. Really, the flagship product when it comes to volatility modeling are these stochastic volatility models. Okay, so we'll introduce that today as well. Now, before I start, I don't know if I'd already emphasized this to you, but the pricing formula is basically a function, right? It's a function of some underlying variables. And the only two variables that we have, do I have it up here? Yeah, okay. So that's the pricing formula for a vanilla call, right? European call. I mean, everything there's a symbol, everything there's a number, right? But they're not all the same, philosophically speaking. Okay? You can think of this as being V of time, S, or S0. Those are really the only two variables we have. Okay? Those are our variables. Those are the things that we expect to be able to change. Okay? Sigma and R are not variables, they're parameters. Okay, did I go over this already? I'm not sure if I did. So sigma and R are parameters to the model. Once you select them, you're basically locking down a specific model. Okay? K and T are trade facts. Once you've selected a particular parameterization, you're trying to price a particular derivative. Okay? Those are trade facts. They don't change. If they change, you're talking about a different derivative, different product. If sigma and R change, you're tweaking a model. Okay? The only things that are really allowed to change, the only variables are time and S. Okay? The purpose of today's lecture is really to take sigma and make it another variable. Okay? So the problem becomes more complicated. You've increased the dimensionality. Okay? You've introduced one additional variable. Okay? So that's really what we're doing today. R will continue to be a parameter. In fact, we make R a variable in week 12. Okay, so that's really the direction we're heading. We're taking Black-Scholes. If we make sigma a variable, that becomes more complicated. When we make R a variable, that also becomes more complicated. K and T don't change. Okay, they're just trade facts. Okay, so let's recap what implied volatility was, okay? And it's just a definition, but if you could observe a market price, and then I'll just stick with call options for now, okay? A particular time to expiry and a particular strike, you can extract the price of options, okay, from the market. And option prices for some of the more liquid stocks, they're very easy to source, right? You ring up a whole bunch of brokers or a whole bunch of dealers, they'll give you a price. Right? You take an average, you get a market average price. So you can come up with a market price of a call option. That's what I call M. Okay. V is everything we've been doing. That's what the model tells us, based on some volatility that we inject. Okay. We've never really spoken about where it comes from. In the same way, we've never really spoken about where R comes from. It's always just there. We get it from somewhere. That was a parameter. But now the important relationship, this is really the definition of implied volatility, is whatever value you need to put into the formula that you have, the Black-Scholes formula, to get out that market price. Okay? That's all it is. And as I said, it's done numerically. And we've only seen two algorithms, but those two algorithms are good enough. More often than not, we use Newton-Raphson because it converges faster. But you should know the algorithm, the initial conditions, the convergence criteria, all the parameters in there. So that's something you should be familiar with. Now, what if I'd used puts instead? Okay, if you can call up, if JP Morgan will give you a price on a call, they'll give you a price on a put for the same strike and expiry. Okay, at the money maybe. So what does that mean for the implied volatility if you extract it from the price of a call versus the price of a put? And the idea is, the result is that you should get the same implied volatility, right? The reason is because that there's this relationship between calls and puts. Okay? Put-call parity, which I think I introduced. If we say the value of the call at time expiry is ST minus K plus the put K minus ST plus CT minus PT is ST minus K. Okay? That's very obvious because if you just plot the payoff diagrams, you see it straight away. But you can use it to then go back in time to make this deduction. Okay? What you have here on either side of the equals are two portfolios, right? You can think of it A and B. You have a portfolio A and a portfolio B. You know at some point in the future, A and B are going to be the same. If they're the same at some point in the future, they better be the same now. Okay? If they're not, there's an arbitrage. Okay? To see the arbitrage, just think if A was less than B today. You'd buy A, sell B. The difference is your profit because you know you're basically long and short two assets which are going to offset each other. Okay? The value of a call at time 0 is just the value of a call at time 0, value of a put at time 0. Everything follows naturally except the K. The K is a cash flow, right? It's an amount, so you need to discount it. Anyway, the point of put-call parity, extremely important, okay? For many reasons. It helps you identify whether prices are sensible. It helps you extract information about a put if you know something about the call. So it's important. So if the implied volatility is not identical, this relationship is violated. Okay? And to see why, just write it. Okay? Convince yourself that they have to be the same. I mean, we've convinced ourselves economically, but go back to the Black-Scholes pricing formula, take the expression for a call, take the expression of a put it inside, and show yourself that it only works if the implied volatility is the same. And the only result you need is to use the normal distribution, the cumulative normal distribution. Okay? That's all you need to see it. If you use that, it comes up somewhere. Things not cancel out, and you get a nice result, ST minus K on the right-hand side. Okay, so the point is that whether you use calls or puts shouldn't matter. Okay? And if it turns out it does matter, then there's an arbitrage somewhere in the market, and you need to figure out where it is. And if there was such an arbitrage, computer algorithms would pick it up straight away, and they would trade, and the arbitrage would go away. Okay, but you need to understand where it is and how you would trade it. Okay, so that's an exercise for you. So we've talked about implied volatility as one option. Okay, so we've just got one option, extracted implied volatility. I'm now going to talk about the two dimensions of our variables. Time first, and then the underlying asset S. Okay, so in terms of time, you can actually extract market prices for a whole bunch of T's, right? Time to expiries, 1 to n. Call up your broker, ask him, call option price on Amazon, expiring in 6 months, give you a price. Expiring in a year, expiring in 2 years, 3 years, 4 years. They'll give you a price for all of them. And you can extract for each of those prices the implied volatility for each expiry, right? You won't get the same number. You may, but you don't have to, right? Because they're all independent, individual inversions of Black-Scholes. But what is important is that you now have what we call a term structure of volatility. Okay? That's what we call a term structure of volatility, because it tells you the volatility for different expiries. Okay? But really what you're thinking about is, what is the probability density function for different expiries? Okay, that's what we're extracting. Volatility tells you the width of the distribution, but it's really this term here, sigma squared t, if you remember, which really defines the width of the log normal distribution. Okay? So you remember ST is S0 some exponential with t plus sigma. You remember this? All the variance comes from this. This is sigma squared t times Gaussian, right? Standard Gaussian. So sigma root t is the standard deviation, which means that sigma squared t is the variance. Okay, so once you extract implied volatilities, you know something about what the market thinks variance will be. You know it's going to be wider as time goes by, right? You know more about what's going to happen tomorrow than in a year. But here you're also extracting the implied volatility, okay? Independent of the time horizon. Okay, so what does this do for us? What do we get from this? I'm going to introduce, probably for the first time, the idea of a bootstrapping algorithm. Bootstrapping means extracting information from information you've already extracted. Okay? It sounds a bit recursive, but you start at some point, you extract some information, Using that information, you extract some more information, and just keep going on and on. Okay? And the idea is what we're going towards now is this idea of forward volatility. Okay? These implied volatilities are what we call outright or spot volatilities. They tell you the total variance from today until each of these horizons, Ti. Okay? What we're really trying to extract now is what do we know about what the market thinks this volatility will look like for some future point in time. Okay? And you can write variance for any time horizon tk as sum, this is how I would characterize it. Okay, these are your time horizons. You've got some idea of volatility over that period, variance over that period. You've got some idea of volatility or variance over that period, right? That's what we've just extracted. Volatility over that period. But what about volatility over this period? Okay, that's what we're getting. The green line and the blue line can be used to extract information about that period T2 to T3. Okay, that's all we're doing. And I hope you see that there must be some information because the information from time 0 to time T2 plus the information from time T2 to T3 must somehow agree with the information you already have about T0 to T3. Okay? And this is the formula. This is your bootstrapping algorithm. Okay? If you start off with k equals 1, k equals 1 means this term disappears. All right? And let's say we take a piecewise constant function for sigma. So sigma, by the way, sigma, the volatility can be a function of time, right? Okay? The simplest thing we could do is make it a piecewise constant function of time. Okay, so T1, T2, and so on. Okay, so if you start off at time T0, this first term goes away. Your piecewise constant, so the sigma comes out because it's constant between k minus 1 to tk. That's the definition of our piecewise constant function. That integral becomes trivial, and you figure out what sigma 1 is, right? Sigma from time 0 to time 1. So you've got that. Now you move on to tk, k equals 2. And you rewrite this. You've just extracted this information. You know what it is. You've just used it. And you make this piecewise constant. You take the sigma out and you continue. Okay? And you just go on and on and on, rolling forward for all the options that you have. And what you get, as I mentioned, is this piecewise constant function of time. But what it really represents is forward volatility. Okay? You've just extracted what I earlier referred to as this gray component, the forward volatility. Okay? And this is an important function. It's just a rearrangement of what I had on the previous slide, where I've imposed the piecewise constant property, so sigma is constant. Okay, so this is just a constant number for this period, right? So this is a formula you should be able to kind of understand and recollect and even apply, right? If you're asked for forward volatility for some period in the future, you look at all you need really are the two volatilities for the two periods, for the two expiries that you're locking down, T1 to T2. You need to know what T1 and T2 are, and it's just that application. Okay? And what is the point of all this? Like, so why are we doing this? Why do we care about forward volatility? Well, because some products, some exotic products, are really, really dependent on forward volatility, not so much the outright volatility. So let's say we're talking about something called a forward starting option. Forward starting option. Has anyone come across these? Nope. Basically, it's an option. If this is T0 today, you've got T1, T2. Your payoff at time T2 is equal to ST2 minus ST1 plus. Okay? What is this saying? It's saying go to time T1, observe the price, so you wait, that becomes your strike. And then your payoff is basically a call option on that strike that you didn't know. We don't know today, but we'll only know at time T1. Okay? So I hope you see you don't care about how much volatility there is here. Right? But what you really care about is the volatility here. Okay? It's forward starting option depends on forward volatility. And if there are events, if this is the US election date when Trump gets elected, probably don't care too much. It's before your period. But if it comes up here, there's going to be a lot of volatility around this forward window that you really care about. Okay, so forward volatility is crucial for certain types of products. We won't see many of them in this course. Really, the takeaway here is that there's this idea that you can extract from the market what the market thinks volatility evolves. This is not a mathematical, by the way, there's no deep maths here. We're just looking at the market saying, I assume you know what you're doing, your prices are good. Based on your prices, this is what you're telling me forward volatility looks like. This is what you're telling me outright volatilities look like. And that's it. We're just extracting information. If you don't believe in it, go work for a hedge fund. Right? Put on trades and prove that the market is wrong. Okay, so that's the forward starting option. Okay, so that was the time dimension. Okay, so with expiry, you can look at the market option prices as a function of expiry. Now let's hold expiry constant and just look at what could happen across a different range of strikes. Okay, so we're looking at one expiry, 1 year option. Option expires certain date next year. So we fix T. And we do the same exercise, except now we're varying K. So before we had Ti, now we have Ki. Okay, for I equals 1 to n. Right? And we extract, again, using the same algorithm, right? You're still using, once you write this Newton-Raphson algorithm, you can use it for whatever you want. Right? All it does is takes a price, spits out an implied volatility. I think you probably will write one. There's no problem set this week, but there will be next week. And I think there's an exercise in Newton-Raphson, so that's worth doing. Okay? Anyway, you extract this implied volatility, and now you'll get sigma I, or sigma, as a function of k, essentially, right? All right, now we'll plot that. And what do we expect to see? What if you saw a flat line? Okay, so you went into the market, you extracted prices. Let me make it very clear. You extracted these prices, which I've put as crosses, and you drew a line because you kind of look for a best fit. If you see that, what is it telling you? Yeah. It's telling you that the market is just basically pricing Black-Scholes. It's nothing better. Or they don't know better. Okay? Oftentimes, and this is true for equity, you'll see something that looks like this. Stock prices, for stock options on stocks. Okay, you see something called this. It's called a skew. For other markets, namely FX and interest rates, you'll see something more like that, called a smile. Okay? Let's try to understand why that is. Okay. Equity options. What we're essentially saying, strike, implied vol, and let's say that this is kind of the flat, a flat Black-Scholes level. Okay. What this is saying is that there's this difference between a standard Black-Scholes and what the market actually trades. Okay, it's a discrepancy. There's a discrepancy in price which translates into a discrepancy in implied volatility. Okay? And what I've got here is that low strike options trade with higher implied volatility. Okay? Higher implied volatility means higher price. Why? Well, we looked at Vega last week, right, or a couple of weeks ago. I think we had a Vega profile, and we convinced ourselves that the Vega looked like that for both a call and a put. We convinced ourselves for the call, but then we used put-call parity. So the Vega is always positive, okay, which means that if you're pricing with a higher volatility, it's more expensive, okay? So why would low strike options price relatively higher than Black-Scholes, but high strike options price relatively lower than standard Black-Scholes? Okay, and to answer the question, I've got the answer up there, but really what it's saying, low strike options, if you think about a Monte Carlo, they only really activate when the price goes down. Okay, the price of a call of let's think of a low strike put option. Okay, low strike put option. It only really activates when you go below the strike, and it's a low strike, so it only really activates if the stock prices go down. Now, what happens when equity prices go down? What's that? Not at the moment. No relation to interest rates. So let's assume in all of this, interest rates are just constant. Okay. It can have an impact, but I don't. The answer I'm looking for is a lot simpler. Okay. What happens? How many people here actually invest in equity? Okay. How would you feel as if your portfolio started going down? Oh, you close it out, right? You panic. You close it out. You decide, you know what? I've had enough. Time to go out. Everybody's watching the prices go down. So everyone's kind of feeling the same. So you sell it. What does that do? It pushes the price even further down. But then you get people who think that this is, temporary, good entry level. I might miss out. I might grab some. Okay? That kind of pushes the price up a little bit. But, the momentum is still downward, so it kind of still goes down. You get this choppy behavior, right? You can see that as prices go down, there's real fear in the market. There's a lot more activity. People buying, people selling. It introduces volatility. Okay? I mean, that's what this is saying. It's saying that as prices goes down, as the stock price goes down, and these low strike puts get activated, you're basically in a world where volatility is getting higher. Okay? But what about when prices are going up? When prices are going up at good times, right? Everyone's happy. No one's really panicked. They're just watching the value of their portfolios grow. People come in, right? They want to get on board as well. But it's all one way. Everyone's buying. So prices are just going higher and higher in a smooth, kind of controlled way. So in that scenario, as stock prices go up, volatility goes down. Okay? And that's what this is showing us. higher strikes, which really only, now think of a call option, okay? Higher strikes, which really get activated when stock markets go up, are associated with lower volatility. Okay? Calm times.
Over here, when we say lower and higher volatility, is that related to the log normal distribution?
Yes, but in general, it's more movement. Okay? Because we don't know what the market's, how it prices. We're assuming it's log normal. It may not be.
Right, but if volatility was identical to log normal, then it should still be a flat line, right?
If volatility, yeah, if in that world, if prices crash, investors don't even know about it. They don't care. They don't act in response. So in that world, the volatility would stay the same. Okay? The relative movement in stocks would be the same whether prices are crashing, going up, or stagnating. Okay? So that would be a pure log normal model. And that's what Black-Scholes says to us. But it's not what we observe, because the market thinks, I don't care what Black-Scholes tells me. If my portfolio is going down, I'm going to sell. Okay? Now, there's actually another reason why these prices down here are higher. Yes, there's higher volatility, as we've described, and higher volatility translates to higher prices, but there's a secondary effect, which is that this region here is really closely associated with low strike puts. And a lot of money managers, investors, they're worried. They're worried about their portfolios going down. They're worried about losing money. So what they do, how do they hedge some of that? Yeah, buy puts, right? So they go out there and they buy puts because it helps them sleep better at night. Okay? They know that if the prices crash, at least they'll get some payout from the put. Okay? And they're so desperate to do this that they bid up these prices. Okay? So that's another reason why they go up. It's associated. It's still this fear factor, but it's a different angle. Okay? Okay, so then that makes sense for equity. What about FX? And FX is really the topic of next week's. So next week we're going to spend time, the whole session, talking about FX. But FX, we get something like that. You don't get this. It's more symmetrical. Okay? Why do you think that is? Right. Yeah, it's really a symmetric problem depending on who you are. If you're looking at dollar yen as your FX pair, as dollar yen crashes, that means the value of the dollar is going down. If you're an investor who has a lot of investments in Japan and you need to convert them to dollars, you're panicking because those investments are losing value. So in that case, you start panicking, but on the other side, Japanese investor would panic. Okay? Interest rates, similar sort of idea. Okay? We also get this kind of symmetric behavior in interest rates because if you're a borrower, you panic when rates go down because you borrowed at 5%, a new loan would cost you 1%, you're not feeling so good, you're trying to get out of your loan. Right? But on the other side, if you're a lender, then you panic if rates increase. Okay, so in FX and rates, you have this kind of symmetrical behavior because you've got two sets of investors. But in equity, not really. Equity, everyone's basically an investor. Pretty much everyone's long. Okay. All right, the key takeaway here is that it really sounds like volatility is not constant. It's time dependent, as we've already seen from the previous couple of slides. But it also feels that it's not even a function of just time, it's also a function of the underlying asset. Okay? It really feels like volatility is a function of the underlying asset S, which means basically that it doesn't behave, the asset doesn't behave according to a log normal model. Okay? It might behave, we might say it looks like that, but that's not log normal. I don't know what distribution that is, but it's definitely not log normal. Okay? Depends on what this form is. And if we're in that world, then what do? We can't price the option. Okay. At least not using a pure Black-Scholes model. We need to do a bit better. And we will, but before that, let's ask the question, well, if the market doesn't believe that the log normal model is valid, well then what does the market think is the distribution? Okay? And we can extract that. Let's do some maths first. Okay, we need to do this to better understand this process of extracting implied volatility, implied probability density from market prices. Okay, so f is a function. Here it's a function of x, y, and t. Okay, and the idea is we want to take the derivative with respect to x of this guy. Okay, and the reason this is tricky is because you've got x in the integration, but then x is also explicitly inside under the integration. Okay? Look, you all know that if I had f of x dx and I wanted to take d by dx of this, that's easy, right? That's just f of x. Okay? What complicates things is that there's an x inside under the integral. So the Leibniz integration rule, have you seen it all? People who've done calculus have probably seen this before. But basically it comes in two parts. You take the derivative as you did without ignoring this guy entirely. Okay, you ignore this guy. So you take the derivative. Okay, there's a typo in the formula. Has anybody seen it? I think some people might have. That's supposed to be a t. Okay, that's a typo. Okay, where was I? So you take the derivative. The first one knocks out the integration, right? It just undoes the integration. The second one differentiates this x. Okay? Throughout all of this, y is just a silent observer, right? Doesn't do anything. So that's Leibniz integration rule. It's a very standard result in calculus. And we're about to use it here. Okay? So call options. We know that the value of a call option can be priced under the risk-neutral framework. Okay? And when I say risk-neutral framework, you all have to know exactly what I mean. I mean that expectation. Okay? Which we can rewrite in terms of the integration. Now, here, I'm choosing to work in the dimension S. Previously, when we derived the pricing formula, I chose to work in the dimension of Z, right? The underlying Gaussian variable. Now I'm just using S because I'm after the probability density function of S. Okay? But that's it. That's the definition of expectation. Okay? It's just that. And this is what I'm trying to extract. So what do? What I can do is take dc by dk. Okay? That's what I would normally try to do to get rid of this integral. The first integral, the first derivative, is just 0. Okay? So if I do this, I'll get 0 plus, I'm going to leave out the exponential term now, it's just a constant. Okay? And if I take the derivative with respect to k, I get this term here. All right, just follow. It's in the notes. Just follow it slowly in your own time. But you'll basically get, I think there's a minus sign. And if you take the second derivative with respect to k, you actually get evaluated at S equals K, right? Something like that. In other words, what are we saying? We're saying we can extract from the market, just by ringing up brokers, the prices of calls for different strikes. This is all for a specific expiry. We can fit some line to it, okay, some smooth function. And if we take the second derivative of that function with respect to K, that's the probability density function. Okay? That is the market implied probability density function. Right? And it allows us to extract the PDF, but we haven't got any dynamics, right? We haven't extracted a stochastic differential equation for S. We haven't got that far. We've just been able to extract an implied probability density function, which if we inject into the risk neutral framework will give us back our market option prices. Okay. Now we could have again used vanilla puts for all of this. You actually get the same result. Okay. In fact, you can use put call parity again. Okay. Take the second derivative. You notice that call minus put, second derivative, has to be equal 0 because everything on the right-hand side is only first order linear in K. Right? So second derivative makes it all 0. Okay, so then we've basically got a distribution, right? Now local volatility functions does exactly the same but in 2 dimensions. Okay, it's a little bit more involved. You would not be expected to do any of this following maths in any exam question. It's too messy. And as I mentioned, these local volatility formulations, I haven't seen them used that much. Not as important as what we're going to talk about in the latter part. But actually, let's take a short break before we start, because the maths is pretty heavy. Let's get back here at 8 o'clock, and then we'll continue with local volatility. maybe I ought to clarify. Next week's midterm is compulsory, right? It's not a makeup for the first midterm. Okay, there are two separate midterms in this module. You've done the first one. I hope everyone's done it. This second midterm is additional, right? It's not a makeup for the first one or anything like that. If you've done the first one, you still have to attend next week. Okay, just to make that very clear. Okay, let's talk about local volatility. So clearly, if anything, I hope I've convinced you that sigma, this implied volatility or volatility for the Black-Scholes model, for a log-normal model, is definitely not constant. It's a function of time, and it's also looking like it's a function of S, the underlying asset as well. Okay. So what we can extract from the market is, again, call option prices for different expiries, but now also for different strikes. So you've now got a surface. Right? Previously we had a term structure. We've now got a surface in 2 dimensions. Okay? You can think of this as a option price surface. And I think there's a squared missing here. But basically, we're going to end up deriving something that looks like this. If we had this surface parameterized nicely as a function, a smooth differentiable function, we can take derivatives, and it turns out that that's the expression. Okay? We'll see where it comes from in a moment. The full derivation is in the notes. I won't go over it in detail here. And as I said, it's useful to see where it comes from, but this model isn't used all that often. Okay? Okay, so the assumption is that once we get this function, what can you do? Assuming you had that function. Okay, and now you know these dynamics are probably more relevant than what you were using up until now, which is a constant or at most time varying deterministic function. But okay, so assuming we've done the maths and we get it, what good is it? What can we now do? Okay, like I've done there. And what can you use this for? You can now price any derivative, right? At the very least, using Monte Carlo. Okay, so when all else fails, use Monte Carlo. It's always there in your back pocket. So you've got some dynamics that you believe in, and you can rest assured that if you actually price a call option, which is on your surface, you should retrace the same price. Okay, that's the magic here. So you now have dynamics which, if you price call and put options, which are on your surface, you reprice them. If you price something else, hopefully you get a good price which is consistent with your surface. Okay, that's why it's powerful. The reason it's not well used is because this form of sigma actually turns out from one day to the next can misbehave. Right? You do it today, ring up your brokers, get your price, you do your calibration, you get some function, come back tomorrow, functions change quite a bit. Right? It's kind of a little bit unstable. I think that's probably why people don't use it all that often. Okay, so let's see the derivation. And one thing we're going to use is the Kolmogorov-Forward equation, which I introduced right at the end of the last lecture. Now, I did say that this is a nice result because it allows you to study the probability density function, how it evolves with time. Okay, where is it? I really introduced it because we use it today. Okay, so again, don't worry about the derivations here. This is not. Consider it kind of supplementary material for the course. Okay, it's important. It's useful for you to see it because you've done so much work, and this is a small step. Okay, and if you take another step, you can actually derive this local volatility function for yourself. Okay, so that's the function, that's the risk neutral expectation. Again, PDF in terms of S. I'm not working in terms of Z today, okay? And it's not obvious to you why we would do this because I'm giving you the summary, but you take the first derivative with respect to capital T, with respect to expiry. Okay, now obviously expiry comes here, but what was probably not obvious to you is that it actually also comes there. Okay? Your probability density function depends on time to expiry, depends on your time horizon. If you're pricing an option with 1 week to expiry, it's tight, right? The distribution is quite narrow. If it's a year, it's wider. So the probability density function does depend on time to expiry. Okay, no differently to Brownian motion. The variance of Brownian motion is time horizon. Okay? So the probability density function depends on time to expiry. We don't know how yet, but it's got to be in there. Okay? So I take the derivative. You can do the calculus yourself. This is, again, integration, differentiating under the integral sign. But this guy is what we looked at previously. Okay? It's basically that. And if you put it in, if you apply the Kolmogorov forward equation, there's a sign change because in one case you're talking about capital T, right? An increase in capital T means your horizon gets longer. An increase in little t actually means you get closer, so your horizon gets smaller, so there's a minus sign. But it's minor details. You put all that in. This comes in here. Okay, so you rewrite it. This is where these terms come from. You know what? Maybe I can show you very quickly. Okay, so these terms are all substitutions from the Kolmogorov forward equation. You can rewrite this one as I1, this one as I2, and I'll let you follow it in more detail, but it's really just chain rule, sorry, not chain rule, integration by parts. Okay? Taking care of the limits. Okay, so you know, for example, that at the limits, PDFs go to 0. You make use of some kind of sensible limits. You solve each of those integrals, I1, I2. Turns out they're not that complicated. I1 looks like this. I2 is a little bit more work, but not that much. Again, all the details are in the notes if you really want to follow it, right? There are some identities that you just need to know, which are easy to prove, but once you know them, you put them in here, put everything together, and basically that's the result. Okay? So you can think of this as being some two-dimensional function. That's all it is. A function of time and a function of S. Okay? Which is all extracted from this surface C that you got from the market. So it's a market implied, I don't want to call it the market implied volatility because that means something very specific. It's the market implied, let's call it volatility surface, right? Function of time and S. But once you've got it, put it into your stochastic dynamics, run your Monte Carlo. Chances are this is too complicated for you to do anything in closed form, but at least you'll be able to run a Monte Carlo. Okay? All right, any questions? You've just seen your first, what's called calibration. Okay? That's what we've done here. We've taken a model. We accepted that we don't know what the volatility looks like, but we acknowledge it's some function of time and S. And we proceeded to fit it to something. We fit it to the surface. That's a calibration. Okay? We do this all the time in finance, right? Especially when we're trying to fit to market prices. We calibrate the model to market prices. And hopefully this is now a kind of a more credible model to price something more complicated. Okay, so calibration. Okay, so that's local volatility. I'm going to shift to really kind of the quintessential model for implied volatility, which is the stochastic volatility model. And before I introduce actual models, and I'll only introduce two, which are kind of the two popular ones, I want to make the case for why stochastic volatility. Why did somebody decide, okay, stochastic volatility just means you randomize volatility, right? We've seen stochastic equity. We use the log normal distribution for it. Somebody figured out stochastic volatility is a good idea, okay? And the idea is this. You can still use Black-Scholes as a base because it contains a lot of kind of useful economics. It's a decent model. You know, it got us pretty far. We're now fine-tuning. Okay? So we don't need to rip up Black-Scholes and start again. We're really in a world where we want to refine Black-Scholes. That's what we'll do today. That's what we're also going to do when we introduce interest rates. Okay? Now recall Jensen's inequality for people who have done statistics. Okay, that's a relationship. The proof is very straightforward. Actually, I've missed something out here. This is not complete. Have people seen Jensen's inequality? If you have a random variable x, and you have a function on a random variable x, that's definitely random as well. Okay? The expectation of the function is greater than the function evaluated at the expectation. Okay, that's what Jensen's equality says, but I've not been complete. It's only true. Anybody know? Convex functions. Only true for convex functions. Okay, so what does that mean? If I do Taylor expansion of f of x around x bar, okay, nothing there. I've just done Taylor expansion around x bar. And if I take expectation, well, this is constant, right? This is just the function evaluated at the expectation. What's this? This is the first derivative evaluated at x bar. So that's just a constant. Expectation of the term in the bracket is 0, right? Just linearity of expectation. So this term's 0. This is a positive quantity. So this inequality holds if this is greater than 0. And that's the definition of a convex function. Okay? Anyway, somebody figured out that if we take the Black-Scholes pricing formula, call that f for the moment, okay? And we think of that function in terms of implied volatility. Okay, so let me write it this way. Okay. They figured out that this is greater than f at some average volatility. Okay. Now this only works if f is convex, and I can assure you it is because we've already looked at it. I think last week, remember this from last week, we plotted the premium, the price, as a function of volatility, right? Looks pretty convex. Yeah, you all agree it's convex. So at least within this vicinity, we can apply Jensen's inequality. Okay, so what we've got is that if you take a Black-Scholes function, but you randomize volatility, and you take the expectation, you get something that is higher than Black-Scholes evaluated at the average. Okay, it's kind of like if that's your average, you get a price that's higher. Okay, that's really what we're seeing here. Okay, this is, call it sigma bar. Okay, for a given strike. For a slightly off strike, you do this averaging, you're going to get a price that's kind of a little bit higher. Okay? So it's precisely what the implied volatility smile is. So here's an exercise for you. Okay? There's no homework, there's no problem set this week. I would love for somebody to be able to do this, write down a bit of Python code and share it with everyone, because I don't have it. Okay? But it's a very, very useful exercise. I did it at some point many years ago. But really, to get this idea clear in your mind, do the following. Set up a random variable, alpha. Okay? And mu and nu are inputs. Okay? So they come in, they're inputs. And price, come up with a function. So you're going to need a function which prices Black-Scholes, right? Standard Black-Scholes. Because you're going to need to do this integration numerically. Okay? You can do that integration numerically because you know the probability distribution of alpha is just normal. Okay? You have to be a little bit careful. What do you have to be careful about? What's the problem with a normal distribution? Yes? Why is that a problem? Because you like disorder. Why? What's the problem with a normal distribution? Values? No. What are the values that the normal distribution can take? Plus, minus, infinity. Okay. So, is there a probability that alpha is negative? Okay. Can be negative, right? If you end up with a negative value and you put it into Black-Scholes, you're going to get a problem. Okay? That's the thing you need to be a little bit careful of. And it really depends on what you choose as mu and nu. But in general, you can get negative values of alpha. So you need to adjust for that. But that aside, you do this integration numerically, right? Just on a grid. Trapezium rule, Simpson's rule, whatever you want. You come up with a price. Okay? This is now your, let's say, enhanced price. Back out from this price the implied volatility. Okay? So you're going to need to write an algorithm, a routine to do Newton-Raphson extraction. Okay? You should be able to do that as well. So now you'll get an implied volatility for strike K. So repeat this for a whole bunch of different Ks, right? And plot what your skew looks like, okay? And then study how mu and nu affect the shape of the skew, right? What you'll find, so if this is Black-Scholes, what you'll find is that nu will give you convexity. Okay? Mu will adjust the level. Okay, so if you increase mu, whatever the shape is, it'll stay the same, but it'll go higher and higher or lower and lower. Okay, that's what you'll find. And this is kind of preparation. This is the motivation, right? This is why somebody, when they found this, decided stochastic volatility probably will do what we want, right? It gives you a way to control the level of volatility, which is the general level of, the level of the skew, which is the general level of volatility in the market. Nu, the V term, controls the wings. It tells you how adverse people are to sell-offs in the market, okay? If they're very adverse to it, you want something that's pretty steep, right? Because they're willing to pay a really high premium to hedge their exposures. Okay, but that's really the motivation. So stochastic volatility will give us this, because stochastic volatility, if volatility is a stochastic process, it has a starting point. That's really what the mu is. It has a volatility, which we actually call the vol of vol, volatility of volatility. That acts like the nu term. There's one more which we'll see, but That's basically just the motivation for what's happening with stochastic volatility models. Any questions on that? Now there is one, I don't know, I hesitate to even bring this up, but you took me at face value here, right? We plotted the results. We see that as you increase volatility, the premium increases. Okay, it comes from the Black-Scholes pricing formula, and it's right. I'm not saying this is wrong, but this is where you should think not just about the mathematics, but what's happening economically. What is this saying to us? If we just extrapolate it, what is it saying? It's saying as you increase volatility to infinity, price looks kind of normal, linear, right? Keeps increasing to infinity. Can the price of a call option go to infinity? Right? Week 1, we introduced some very basic bounds on the price of an option. And we said for a call option, it can never be more than S. Can't be, right? Otherwise, there's an arbitrage. So what do we know must happen here? Okay. It's got to do this at some point, right? It's got to do that at some point. So if you're here, you're not really convex, okay? 99.99% of the time we're here, okay? So this is not a problem. But I wanted to use it as an example, right? It's very easy to just run with the maths, but you've got to stop and think about what's actually happening economically. And it's economics that told us that that can't just grow, right? It's economics that told us that it has to level off, okay? Okay, slight detour, but let's continue with stochastic volatility. So I'm going to introduce two models. And in this course, really, I'm just going to introduce the parameterization of the model, the definition. We're not going to solve it. We're not going to come up with a pricing equation. It's actually very complicated. It's hot topic in research. But I'll introduce the two models that are most used in the market. Okay. One is called the Sabre model, which is stochastic alpha, beta, rho. This is by far the quintessential stochastic volatility model, right? This is what every bank, every finance institution uses, okay? Especially for interest rates and to a certain extent FX, but certainly for interest rates, okay? So what are the parameters? We have essentially two random processes. Okay, so we've got volatility, which is itself now a random process. Okay, so if you want to think about this as a Monte Carlo, you start off with some F0, sigma 0, simulate one step forward, F changes, but then sigma changes as well. You simulate the next step, but now with the new sigma, and so on. Okay, but there's a correlation between the two. Okay, so the important parameters are really correlation, the initial starting point of sigma, and this, the vol of vol, right? The volatility of sigma, which is the volatility of volatility. There's a beta term, but we'll come back to it later. And in case you're wondering what's F and why have I not used S, you'll notice there's no R term there. This will become clearer next week, right? I'll talk about why we dropped the R. This is a trick we can use, okay? F is actually the forward price. So if some of you want to read ahead, you'll remember the forward price is basically the stock price times some exponential of R. If you try to work out the dynamics of the forward price, you see that the R cancels right in the drift. And why we do that, well, wait till next week. But anyway, that's near here nor there. It's a drift anyway. And in this world, it would be a constant drift because we haven't made rates stochastic yet. But the three important terms are the ones in red, and I'll talk about beta separately. Okay? So the question is, what do you expect? And I think for this course, you need to remember, you need to recognize the model for sure. But what I would like you to be able to do is understand what the parameters are, remember what they are, recall them, but also remember what they do. What they do in terms of the effect they have on the skew. Or the smile, if you want to call it. Right? The vol skew. Okay, so sigma 0. What do you think that does? Sigma 0 is where sigma starts, and sigma is kind of the level that's injected in the underlying stochastic variable. Sigma is a log normal. It's a martingale, so it kind of has a tail, but it has a width, a distribution, but it's centered around sigma 0. All right, so what do you think is the effect if I had a skew and I changed sigma 0? Shift it. Left, right. More like up, down. Right? Up, down, right? Because, yeah, this is strike in this direction. This is implied volatility in this direction. Increase sigma, kind of, everything gets pushed up. So yeah, so sigma 0 will do that. Okay, what about nu? Okay, nu we already saw. I gave you a clue. It kind of makes it more convex. So you'll probably end up with something like, if you increase nu. What about correlation? What do you think correlation does? This is the correlation between the underlying, okay, forget how it's forward, it's the forward price at the moment, it's the underlying. It's the correlation between the underlying and volatility itself. So what are your thoughts? Think about a Monte Carlo. You're simulating your price. Yeah, more momentum. So let's say correlations become more negative. Okay, so under here you had correlation equals 0, and now I'm thinking, well, what would it look like if correlation was minus 60 or minus 70%? Okay, nearly there. Think about what happens as rates go down, or as the underlying asset goes down. Because of the negative correlation, volatility goes up. Okay? And consequently, as rates go up, I keep saying rates, as the underlying asset goes up, volatility is going to go down. So if you think about it, call options get cheaper, put options get more expensive. Right? So what you get is a tilt. So it would do something like that. Yeah? Implied vol on the left-hand side goes up, but on the right it comes down. And if volatility became positive, it just tilts the other way. Okay? But that's it. I mean, if you use sort of that kind of mathematical reasoning, you can understand what the different parameters do. And for this course, that's probably enough. Right? There is actually a formula to this model. Okay, it's a very famous paper. The maths is very heavy, but it's been around for about 25 years. So people have been using this for about maybe 20 years. Okay, and it's basically the quintessential model for stochastic volatility. Okay, I said there will be two models, so here's another one. So by the way, here he managed to come up with a closed, semi-closed form. Pricer. Okay, semi-closed form because he made some approximations which break down under certain circumstances, but if you're outside of those restrictions, the closed form formula is pretty good. It's super fast, right? It's a formula. Okay, this is another one, Heston model. It's very similar to Sabre, right? You've got a volatility term here, but now you're modeling the variance as a stochastic process. Okay? If root sigma is the volatility, then sigma is the variance, right? Square. You still have a correlation. So these terms we've seen before, and they play exactly the same role. Okay? The new terms are really, it's just that one there. Okay? It's the mean reversion rate and the level. Don't worry about the level. The level you can use to calibrate to the term structure. Okay? But the mean reversion is the interesting one because that actually helps us to control forward vol. Okay? Which is something Sabre can't do. Okay? Sabre doesn't give you the means to control forward vols. So in other words, if you're pricing a product that isn't dependent on forward vol, Sabre's okay. If you need a handle on forward vol, you probably need Heston. Okay? And Heston is a bit more complicated to solve. It uses something called the fast Fourier transform. It's much more numerical. It's slower. I think there was a very, very good paper by the late Peter Carr. Okay, he wrote a very good paper if you're interested in reading that. You don't need to read the paper for this course. You don't even need to know the solution or the fast Fourier transform for this course. But you do need to understand the parameters, what they are, what they mean, how they affect the skew. Okay? So really, kappa won't affect the skew because skew is not a forward vol type of measure, right? It's measuring the implied volatility, the outright implied volatility. But what you find is that if you use this to price some sort of forward starting option, you've got a handle to calibrate it. If you think it's too high, you change kappa, it brings it down a bit, while still repricing everything else in the market. Right? You don't have that extra handle in Sabre. Any questions? Okay, so the whole point of all this, as I've mentioned, is you calibrate to vanilla options and you price stuff that's exotic. Okay, that's really the purpose. Black-Scholes, good enough for calls and puts, but you can use it to refine your model, the Black-Scholes model itself, either by using a stochastic volatility model or a local volatility model. The point is you now have a credible model to price something more exotic, something that's going to reduce to call options and put options and reprice what's in the market. Okay, so Smile dynamics. Now, one thing that's changed today, I think last week I introduced this term and I said, we can't really do that. Okay, in a pure Black-Scholes world, where sigma is a parameter, we can't really do that. Sure, we can measure it, right? It's nothing stopping you taking a formula and taking the partial derivative. But the argument I made is that that expansion doesn't mean anything. It's not, you can't use it as part of your hedging. Okay? When we did the dynamic hedging, like the demo a couple of weeks back, I didn't have a term with Vega. It was just delta hedging. Well, now with stochastic volatility, because sigma is a variable, you can actually say this. So this is really a new term. Okay? This is a new term. And under a stochastic volatility model, it's a valid term. It's in fact it's a first order term that you can't ignore. Okay? But it turns out, and we know this already because we said that sigma is some function of time and s. Right? We've said that already. So we can rewrite this. Okay, that's how I'm going to rewrite it. That's where this term comes from. This is what I mean by Smile dynamics. How does the implied volatility change when the underlying asset price changes? Okay, we know that they have a relationship. That's the whole point of today's lecture, is to adjust for it. Well, we've adjusted for it. But now we need to say, how does the implied volatility change when the S changes? And you can rewrite this, you can recombine these two terms, right? They're both delta S now. So delta becomes This is often called a skew-adjusted delta. Okay. It takes the Black-Scholes delta and then adds something to it. Makes it better. It makes it more aware of the existence of a skew, first of all, and it also makes it more aware of the fact that this skew depends on the underlying asset as well. Okay, so you get a skew-adjusted delta. But this term here comes purely from the model. Okay, and for Sabre, I don't know what it is for Heston, but for Sabre, it's this term here, and that's where the beta comes in. Okay, so beta is a term which tells you how your implied volatility changes with S. If you pick beta to be 1, and you can choose that, you can choose this, it's a choice. You're basically saying that sigma doesn't change with S. Okay? Sigma does not change with S. That means your Black-Scholes delta and your skew-adjusted delta are pretty much the same. Okay? It does not mean your price is the same. I'm not saying we're throwing stochastic volatility out the window and we're back to Black-Scholes. That's not what I'm saying. The prices are very different. But the delta turns out to be the same. Okay? And that's called sticky strike. Okay? It means implied volatility does not change as the asset price moves. Okay? So this derivative here is 0. Sticky delta would be the case with beta equals 1, for instance. Okay? It means that there is a relationship between the implied volatility and the asset price, which comes into your skew-adjusted delta. Okay? Any questions? Anything? To close out, I just want to give you kind of a bit of a... I feel like I've not said enough about stochastic volatility. I threw this model at you, and I said, trust me, it works. Okay? We didn't do any replication. We didn't do any self-financing strategies. We didn't do any of that. We kind of just... I waved my hands, and none of you challenged me. But it still works. The point is that we're going to do this again when we do interest rates, because it's the same idea, right? We're taking a different parameter and making it a variable. But just to kind of give you a bit of a sense, this is the model, and I'll do it for Sabre. Okay, this is the model. We still use the same arguments that we've used. Okay, those foundations are key. The idea of a replicating strategy, self-financing strategy, setting up this portfolio pi, okay, which is just the derivative plus what I call C, the replicating portfolio. And now I'm saying that this replicating portfolio, previously we just had the two terms here and here, right? We didn't have this previously. Okay. I'm going to introduce what I call V1. And V1 might be a call option, because we're saying now that call options are traded in the market. We have a price, so we can trade it. We can buy and sell it. In the same way, we can buy and sell the underlying asset. In the same way, we can invest in a money market account. It exists. Okay? So let's use it. We put it into our hedging portfolio. And the idea is, as always, to ensure that pi 0 starts off at 0 and d pi is 0 for all time, right? That's what we're trying to do. If we can ensure this, then we have replication. Okay? All right, so that's what we've done before. The difference is now V is a function of time S and sigma. Okay? or I should write sigma t, to emphasize it's stochastic. Okay, it's a function of 3 variables. So the expansion becomes more complicated. I mean, I don't want to say more complicated, just more terms. Okay, it's just Taylor. You've seen a new first order term, a new second order term, which we keep because again, there's an Ito correction, and then there's a cross term. Okay, but this is not new because we've seen basket options, right? We've seen multi-dimensional Black-Scholes. You can think of it that way if you want. This is true for V and V1. Okay, because V1 is a derivative. V1 is, let's say, the call option, and V is whatever exotic option we're trying to price. Now, to keep this, to enforce this critical condition, okay, we have to eliminate randomness. That's really what delta hedging is doing, right? You have no hope for d pi to be 0 if you've got randomness in there. You can't control randomness. Okay, so you have no hope. You've got to eliminate it. If you eliminate randomness, you have a chance of ensuring that condition. Okay, so you do that. And I'll let you go through the details, but essentially you want to knock out this term with that term. You want to knock out that term with that term. You end up with 2-dimensional hedging. Hedging in this dimension S, hedging in the dimension sigma. Okay, it's just a 2D extension to what we've seen already. Okay, you go through the mathematical details if you want. We're going to go over it again with interest rates, but the point is you end up with a partial differential equation. Okay, which looks very similar in a lot of ways to the Black-Scholes partial differential equation, just more terms. Okay, we've seen this guy already. This, and this are just the old terms. Okay, the new terms are just this one, and this one. Okay? But that's just a partial differential equation. And again, you can use the same trick. Feynman catch, apply it in one extra dimension, take that to be a function, expand it, take expectations. Miraculously, okay, so this is all happening here, you still get that result. Okay? Risk-neutral valuation still works. Okay, it still somehow works. So that means you can come up with any model for sigma, take the expectation, and remember, at the very least you have Monte Carlo. Right? If you need to resort to Monte Carlo, you can do it. There are some technical things you need to look out for, in the same way that when we use Feynman catch, we figured out that the drift of S has to be R. Okay? It turns out that you have to adjust the drift of sigma to be something A. And A is unspecified at this point. Okay? If you follow through the maths, you'll see that A has to be a function. We know it exists, we don't know what it is. Okay? What we end up doing is calibrating A to the prices of options, of call options. Okay? Because we made this kind of heroic assumption that we can trade options. And if you do that, you're kind of a little bit in an egg and chicken and egg scenario, right? You're trying to come up with a framework to price a derivative, but you've already got a derivative. So what you do is this whole framework is saying, I'm going to set up a framework which prices my derivative with no arbitrage, but I'm going to assume that the option prices that I have are no arbitrage to start off with. Okay, so I'm going to calibrate my model to them, and that's where I get this A from. We're getting a bit detailed now, right? We're going into the details. But I just wanted to convince you that there is an economic hedging argument behind all of this. Okay, even though the model is complicated, it's only a little bit more complicated than the multi-dimensional case that we saw earlier, right? In the multi-dimensional case, we didn't have to worry about this A. It didn't come up anywhere because we didn't have this chicken and egg scenario, right? We were just pricing a basket option. Here we're pricing an option complicated option, assuming a simpler option already exists. Right. Any questions? I feel people's brains are sizzling, so maybe we can break early. I appreciate that this is all new material and you've got a midterm next week, so I wasn't joking when I said earlier it will be a light touch on stochastic volatility, right? In fact, just be familiar with the idea of implied volatility or forward volatility, limits to volatility, and that should be enough, okay? But in terms of the exam, stochastic and implied volatility are pretty, big enough topics that you should probably expect something to come up at some point. Okay, any last minute questions, either about the material today, last week? There's no problem set. There will be one next week. Oh, another announcement, actually. So I should have mentioned this earlier. So we will have the assessment in Auditorium 2 in Newtown. Immediately after the assessment, we'll have a short break, but we will continue with the lectures at the same venue. Okay, so you don't need to come back here. Right, so we'll just stay on. We'll have week 11. We'll introduce foreign exchange, and we'll just stay at the same venue. Okay, remember to bring your scientific calculators, cheat sheets, whatever you need, and that's it. If there are no more questions, then we can end early. Sorry, for the final exam. The midterm.
Yeah. Is it everything for free?
Everything until today.
And what is the cheat sheet? Is it like one cheat sheet or?
Unlimited. I mean, you can bring whatever you want. You can print out all the lecture notes and bring them along. The point of the midterm is it's a chance for you to assess how much you've really learned. Okay. I like to think that certainly for the first midterm, if you were unsure about some of the questions, like completely unsure, it's a signal that you need to go back and really strengthen some of the foundations. Those are basic, really foundations. Next week's midterm is a similar sort of concept. Okay, we're talking about foundations. You're not going to need to know detailed derivations from the notes or from the problem sets, but you should know kind of the basic concepts. I mean, I didn't write the first one. I don't know. I think this one is more challenging. Yeah, I think it is more challenging. Multiple choice primarily, but you will need your calculators to maybe make the choice, right? To do a bit of calculation and figure out which one's the right answer. You won't be writing any code for sure. Kind of. I mean, not fill in the blanks, but there could be a question that asks for a numerical answer, and you have to work it out. No, in that case, it would be fill in the blank. Okay, see you next week.